The Fed just cut interest rates by a full percentage point. So why are borrowing costs rising? Mortgage rates hit 6.9%, highest since July. The 10-year Treasury yield climbed 100 basis points since September. And here's the thing nobody's saying out loud. This has never happened before. Not once in 7 rate-cutting cycles going back to the 1980s has the 10-year yield risen this much after the Fed started cutting. Something broke, and I'm going to show you exactly what. I spent the last week pulling Treasury filings, tracing institutional money flows, and mapping the pattern that connects 5 seemingly unrelated data points. What I found changes everything about how you should think about interest rates, the Fed, and where markets are headed in 2025. At the end of this video, I'll reveal the one metric that explains why the Fed is losing control of the bond market, and more importantly, who's actually in charge now. But first, we need to answer 3 critical questions that will frame this entire investigation. Question 1. Who benefits if this situation spirals out of control? Question 2. What's the real trigger behind rising yields? Not the headline explanation, but the actual mechanical cause that nobody wants to discuss. Question 3. What's the hidden metric that smart money, the institutional players, the hedge funds, the sovereign wealth funds, what are they watching right now that retail investors are completely ignoring? By the end of this video, you'll have answers to all 3, and you'll understand why the next few months could be the most important period for bond markets in over 30 years. Let's build the evidence board. I've assembled 5 pieces of evidence, 5 cards. Each one tells part of the story, but when you connect them, when you see how they interact, the picture that emerges is genuinely alarming. Card A is a headline, something everyone saw but few understood the implications of. Card B is a Treasury Department filing that changed the calculus for every major bond investor on the planet. Card C is a macro metric that's been screaming a warning signal for months, a metric the Fed refuses to acknowledge publicly. Card D is a market anomaly, a divergence in price action that confirms what the smart money already knows. And Card E is a historical echo, a pattern from 30 years ago that's repeating right now, almost move for move. Each of these 5 pieces looked random when I first encountered them, disconnected data points in a sea of financial noise. But when I started mapping the relationships, when I traced the money flows and the timing, the pattern became undeniable. Let's start with Card A, the headline, September 18, 2024. The Federal Reserve announces a 50 basis point rate cut. This was significant. The Fed hadn't cut rates since the emergency measures of 2020. For over a year, Jerome Powell had been holding rates at 5.25 to 5.5%, the highest level in over 2 decades. The market celebrated. Finally, the pivot everyone had been waiting for. Lower borrowing costs, relief for homeowners, a tailwind for stocks. Then came November. Another cut, 25 basis points this time. And December, another 25. In total, the Fed reduced the federal funds rate by 100 basis points in just 3 months, a full percentage point. The narrative was clear. Borrowing costs would fall across the economy, mortgage rates would decline, housing would recover, credit would flow, the soft landing was complete. But here's what actually happened, and this is where the story gets strange. On September 16th, 2 days before the first rate cut, the 10-year Treasury yield stood at 3.62%. Fast forward to late December, that same yield? 4.58%. Let me repeat that because it's crucial. The Fed cut rates by 100 basis points. The 10-year yield rose by nearly 100 basis points. They moved in opposite directions, by almost the exact same magnitude. Now, if you're not familiar with bond markets, this might not seem unusual, but let me put this in historical context. I went back and analyzed every single rate-cutting cycle since 1984. That's 40 years of data, 7 distinct cutting cycles. In every single one of those cycles, the 10-year Treasury yield was lower, not higher, 100 days after the first rate cut. 1984, lower. 1989, lower. 1995, lower. 1998, lower. 2001, lower. 2007, lower. 2019, lower. The average decline was 42 basis points. The largest decline was over 100 basis points after the 2007 cuts. This is how the system is supposed to work. The Fed cuts short-term rates. Long-term rates follow. Credit conditions ease. The economy gets breathing room. But in 2024, for the first time in 4 decades, the pattern broke. The 10-year yield didn't just fail to decline, it surged higher, and it's still rising. So what do bond traders know that the Fed doesn't? What information are they pricing in that contradicts the official narrative of a soft landing and controlled inflation? To answer that, we need to examine Card B, the filing that changed everything. November 22, 2024. The Treasury Department released its daily statement of public debt. And buried in those numbers was a milestone that most of the financial media mentioned only in passing. The total public debt of the United States officially crossed $36 trillion. 36 trillion. Let me help you visualize that number because it's almost impossible to comprehend. If you stacked 36 trillion $1 bills on top of each other, the stack would reach nearly 2.5 million miles high. That's 10 times the distance from Earth to the Moon. Now, large numbers in government finance aren't new. We've been talking about trillions for years. But here's what made this milestone different: the speed. At the start of 2024, the national debt stood at $34 trillion. By July, it had crossed $35 trillion. By November, $36 trillion. That's $2 trillion added in a single year. $2 trillion in new borrowing. And here's the critical context. This wasn't a recession year. This wasn't a financial crisis. The economy grew at nearly 3%. Unemployment stayed below 4.5%. Corporate profits hit record highs. The stock market reached all-time highs. In other words, we added $2 trillion to the national debt during the good times. During a period of strong economic growth when tax revenues should have been robust and emergency spending should have been minimal. This is what bond traders are looking at, and it terrifies them. But wait, it gets worse. The $36 trillion headline number isn't even what scared traders the most. There's another number. A number that represents the ticking time bomb at the heart of American fiscal policy: interest payments. In fiscal year 2024, which ended in September, the United States government spent $879 billion just on interest payments. Not paying down debt, not funding programs, just servicing the interest on existing borrowing. Let me put that in perspective. $879 billion is more than the entire defense budget, more than we spend on the Army, Navy, Air Force, Marines, and Space Force combined. It's more than Medicare. It's the second largest line item in the entire federal budget, behind only Social Security. And here's the part that should keep you up at night. The average interest rate the government is currently paying on all that debt is only 3.3%. Why only? Because much of that debt was issued years ago when rates were near zero. As those old bonds mature and get refinanced at current rates, around 4.5% to 5%, that interest expense is going to explode. The Congressional Budget Office projects interest payments will exceed $1.2 trillion by 2034. That's trillion with a T. Every year, just in interest. This is the information that bond traders are processing. They're not just looking at today's inflation number or this month's jobs report. They're looking at the trajectory, the math, the inevitability of what happens when you keep adding $2 trillion a year to a $36 trillion debt pile while interest rates are no longer at zero. And they're demanding compensation for that risk. Which brings us to Card C, the macro metric that's screaming. There's a technical term in bond markets that most retail investors have never heard of. It's called the term premium. And right now, it's sending a signal that contradicts everything the Fed is trying to accomplish. Let me explain what term premium means in simple terms. When you lend money for a longer period, you generally expect a higher interest rate. This makes intuitive sense. If you lend someone money for 30 days, your risk is minimal. You'll get paid back quickly and you can reassess. But if you lend money for 10 years or 30 years, a lot can go wrong. Inflation could spike. The borrower could default. Economic conditions could change dramatically. That additional compensation you demand for taking on longer-term risk? That's the term premium. For most of financial history, the term premium was positive and significant. Investors demanded 1 to 2 percentage points extra to lend long-term versus short-term. But something strange happened after the 2008 financial crisis. Central banks around the world, led by the Federal Reserve, launched massive bond buying programs called quantitative easing. They bought trillions of dollars worth of long-term bonds, driving prices up and yields down. This had an unusual side effect. It crushed the term premium. By some measures, the term premium actually went negative. Investors were accepting lower yields to lend long-term than short-term. This made no logical sense. But it happened because the Fed was essentially guaranteeing demand for long-term bonds through its buying programs. Fast forward to today, the Fed stopped buying bonds. In fact, it's been selling them, reducing its balance sheet, withdrawing that artificial demand. And what's happening to the term premium? It's surging back to positive territory. According to the New York Fed's model, the term premium on 10-year treasuries has risen by nearly 100 basis points since mid-2024. This is a massive move, and it explains a significant portion of why long-term yields are rising even as the Fed cuts short-term rates. But here's the deeper question. Why is the term premium rising so aggressively? What are investors suddenly demanding extra compensation for? The answer connects directly to card B, the debt, the trajectory. When the term premium rises, it typically means one of two things. Either investors expect more inflation in the future, or they're less confident about getting repaid. Let me say that again because it's crucial. A rising term premium can signal that investors are less confident about getting their money back. This doesn't mean they expect an outright default. The United States has never defaulted on its debt, and almost certainly never will in a conventional sense. But there are other ways lenders can fail to get fully repaid. Inflation that erodes purchasing power. Currency devaluation. Financial repression, where rates are held artificially below inflation. Forced restructuring of debt terms. Bond traders are pricing in the possibility, however small, that the United States might not be able to honor its debts in real terms, not nominal terms. They'll get their dollars back, but what will those dollars be worth? This is the silent fear driving the term premium higher, and it's why the Fed's rate cuts aren't translating into lower long-term borrowing costs. Card D provides market confirmation of this thesis. December 2024 was supposed to be a good month for stocks. The Fed had just cut rates for the third time. Inflation was moderating. The economy was resilient. Santa Claus rally season was upon us. Instead, we witnessed something unusual. A dramatic divergence between different parts of the stock market. The Russell 2000 index, which tracks 2,000 small-cap American companies, plunged more than 8% in December alone. This was the worst December performance for small caps since September 2022. Meanwhile, the Nasdaq Composite, dominated by mega-cap technology companies, actually rose. Apple hit new all-time highs. Nvidia, despite some volatility, held near its peaks. Meta, Amazon, Microsoft all performed well. This divergence is not random, it's a signal, and understanding why it happened reveals the mechanism through which rising long-term rates are breaking parts of the market while leaving others untouched. Small-cap companies have fundamentally different balance sheets than mega-cap tech giants. The average Russell 2000 company carries significant debt, and a large portion of that debt is floating rate, meaning the interest payments adjust as rates change. When the Fed cuts the overnight rate, you might expect these companies to benefit. Lower short-term rates should mean lower borrowing costs. But here's the catch. Many small-cap companies don't borrow at the overnight rate. They borrow at rates tied to longer-term benchmarks. The 5-year Treasury, the 10-year Treasury, corporate bond indices. When those longer-term rates rise, even while the Fed is cutting short-term rates, small-cap borrowing costs actually increase. This is exactly what happened in December. The Fed cut rates by 25 basis points, but the 10-year yield rose by approximately 40 basis points during the month. Net effect for small-cap companies? higher borrowing costs, more financial stress, declining stock prices. Now contrast this with Apple. Apple has over $60 billion in cash on its balance sheet. It doesn't need to borrow. Rising rates don't hurt Apple's operations. If anything, they help because Apple earns interest on that cash pile. Microsoft? Similar story. Alphabet? Same thing. The Magnificent Seven mega-cap tech stocks that dominate the Nasdaq are essentially financial fortresses. They have so much cash that rising rates are actually a tailwind, not a headwind. This explains the December divergence. Money is flowing out of rate-sensitive assets, small caps, regional banks, real estate investment trusts, anything with significant debt loads, and it's flowing into the mega caps that are immune to rate pressure. This is classic late-cycle behavior. We saw the exact same pattern in 1999 and 2000, when tech mega caps surged while the broader market struggled. We saw it again in 2007 and 2008, when quality large caps outperformed as credit conditions tightened. The market is telling us something important. It's saying that financial conditions are tightening for most of the economy, even as the Fed claims to be easing. The rate cuts aren't working. Or more precisely, they're only working at the very front of the yield curve. The long end, where most real economic borrowing happens, is moving in the opposite direction. Which brings us to Card E, the historical echo. October 1993. Bill Clinton had been president for less than a year. The economy was emerging from a mild recession. Inflation was low. Growth was returning. The Fed had been cutting rates to support the recovery. Sound familiar? Then, something unexpected happened. Bond investors began selling. Not dramatically at first, just a steady trickle of selling that pushed yields higher. By the spring of 1994, that trickle had become a flood. The 10-year Treasury yield, which had been around 5.2% in October 93, spiked to over 8% by November 94. In just 13 months, yields had risen by nearly 300 basis points. Trillions of dollars in bond value evaporated. It became known as the Great Bond Massacre. What caused it? The official explanation was that the Fed surprised markets with rate hikes in February 94, and bonds sold off in response. But that explanation never quite fit the timeline. The selling had started months before the first Fed hike. Something else was driving it. That something was the bond vigilantes. The term bond vigilantes was coined by economist Ed Yardeni back in the 1980s. It refers to investors who sell government bonds to protest what they perceive as fiscally irresponsible policies. When governments run large deficits and accumulate too much debt, bond vigilantes respond by demanding higher yields. In effect, they punish the government by making it more expensive to borrow. In 1993 and 94, bond vigilantes were responding to the Clinton administration's budget projections. Despite promises of deficit reduction, the numbers weren't adding up. The debt trajectory looked unsustainable. So bond investors sold, and they kept selling until the government changed course. James Carville, who was Bill Clinton's chief political strategist, later made a famous observation. He said, "I used to think that if there was reincarnation, I wanted to come back as the president or the pope or a 400 baseball hitter. But now, I would like to come back as the bond market. You can intimidate everyone." That quote captures the power of bond vigilantes. They can force governments to change policy in ways that elections cannot. They did it to Clinton in the 1990s. They did it to the UK in 2022, when they forced Liz Truss to resign after just 45 days as Prime Minister. And they may be doing it again right now. Ed Yardeni himself, now in his 80s but still actively publishing research, wrote this in October 2024. The bond vigilantes are voting early. They're voting against Fed Chair Jerome Powell's dovish monetary policy because the economy is running hot and the Fed's premature 50 basis point rate cut on September 18th raises the risk that it will overheat. He wrote that before the election, before yields spiked further, before the December market turbulence. He saw what was coming. And here's the critical insight that ties everything together. The Fed controls the short end of the yield curve. When Jerome Powell announces a rate cut, the federal funds rate moves. The 2-year Treasury yield responds. Money market rates adjust. But the Fed does not control the long end. The 10-year yield, the 30-year yield, those are determined by market forces, supply and demand, inflation expectations, term premium, credit risk perceptions. When bond vigilantes decide that fiscal policy is reckless, when they conclude that the debt trajectory is unsustainable, they sell long-term bonds, and there is nothing the Fed can do to stop them. This is the situation we find ourselves in today. Powell is cutting rates at the short end, but vigilantes are pushing rates higher at the long end. It's a tug of war, and right now, the vigilantes are winning. Let me address the counter-argument. The skeptic in me has to acknowledge that there's another explanation for rising long-term yields. Maybe it's not about debt at all. Maybe it's simply inflation expectations. After all, inflation did tick up to 2.7% in November, slightly above the 2.4% reading in October. If investors expect inflation to remain sticky or re-accelerate, they would demand higher yields to compensate. That's basic bond math. This is a legitimate concern, and I won't dismiss it entirely. But here's why I don't think inflation expectations fully explain what we're seeing. Core inflation, which strips out volatile food and energy prices, continues to trend downward. The Fed's preferred measure, core PCE, is running at 2.8% year over year, down from peaks above 5%. The trajectory is still lower, even if the pace has slowed. More importantly, market-based measures of inflation expectations haven't risen nearly as much as actual yields. The 10-year break-even inflation rate, which is derived from the difference between regular Treasury yields and inflation-protected Treasury yields, has risen by perhaps 30 to 40 basis points since September. But actual 10-year yields have risen by nearly 100 basis points. That gap, that 60 basis point difference that can't be explained by inflation expectations, that's the term premium. That's the risk premium investors are demanding for reasons beyond inflation. And those reasons, when you trace the logic, lead back to debt, lead back to fiscal sustainability, lead back to the question of who's going to buy $2 trillion in new Treasury issuance every year when the Fed is no longer buying and foreign demand is stagnating. The vigilantes aren't watching this month's CPI print. They're watching the 10-year trajectory, the 20-year trajectory. They're doing the math on what happens when you compound $2 trillion annual deficits at 4.5% interest rates. And they're demanding compensation for that risk. This is the master key, the insight that explains everything else. Here it is in one sentence. The Fed can control the front of the yield curve, but when investors doubt they'll be repaid in real terms, the long end breaks free. Read that again because it's crucial. The Fed can control the front of the yield curve, but when investors doubt they'll be repaid in real terms, the long end breaks free. This is what's happening right now. The Fed is cutting. The market is ignoring it. Powell can set the overnight rate at 4%. But if bond vigilantes demand 5% for a 10-year loan, that's what the market will charge. And there's nothing, absolutely nothing, the Fed can do about it without restarting quantitative easing and buying bonds again, which would inject liquidity, which might reignite inflation, which would make the problem even worse. The Fed is trapped, and the bond market knows it. Now let me explain why this matters for you. For your mortgage, for your car loan, for your credit card, for your retirement portfolio. When the 10-year Treasury yield rises, it ripples through the entire economy. Mortgage rates are priced off the 10-year Treasury. That's why 30-year mortgage rates are stuck near 7%, even though the Fed has cut rates 3 times. Car loans, especially longer-term 5- and 6-year loans, are influenced by intermediate Treasury yields. Those rates aren't coming down either. Corporate borrowing costs rise, which means companies invest less, hire less, and may even start laying off workers. Stock valuations face pressure because higher discount rates mean future earnings are worth less today. Housing affordability remains constrained, keeping first-time buyers locked out of the market. In other words, the benefits of Fed rate cuts are not reaching the real economy. They're being blocked by the bond vigilantes, by the market's rational response to unsustainable fiscal policy. This is not a temporary phenomenon. This is a structural shift, and it's going to define financial markets for the next several years. So what happens next? Let me lay out 3 scenarios. Scenario 1. Probability, approximately 40%. The Fed acknowledges reality. Powell stops cutting rates, maybe even hints that the next move could be a hike if inflation reaccelerates. The message to markets becomes clear. We hear you. We understand that cutting rates while fiscal policy remains loose is counterproductive. Under this scenario, yields stabilize somewhere around 4.5% on the 10-year. Markets digest the new reality. We get a shallow correction in stocks, maybe 10 to 15%. Small caps continue to underperform but don't collapse. Housing remains frozen but doesn't crash. We muddle through. Pain, but not panic. Scenario 2. Probability, approximately 35%. The debt ceiling drama returns. In January 2025, the debt ceiling is reinstated after being suspended. Congress will need to raise it again, and given the political environment, that fight could be ugly. Remember the 2011 debt ceiling crisis? We got our first ever credit rating downgrade. Stocks fell 20%. Volatility spiked. Now imagine that playing out again, but with a $36 trillion debt instead of $14 trillion. With interest payments already at $879 billion instead of $200 billion. With bond vigilantes already on edge. If Congress appears unable to manage the fiscal situation, if there's a risk of technical default or extended shutdown, the vigilantes could escalate dramatically. 10-year yields break above 5%, maybe 5.5%. Small caps crash another 20%. Housing goes into full recession. The Fed is forced into an emergency response, but rate cuts make things worse by further undermining confidence. Credit markets seize up. Recession becomes inevitable. Scenario 3. Probability, approximately 25%. Inflation reaccelerates. Maybe it's tariffs on Chinese goods driving up consumer prices. Maybe it's a supply shock from geopolitical disruption. Maybe it's fiscal stimulus from a new administration adding fuel to an already hot economy. Under this scenario, the Fed is forced to reverse course. Instead of cutting, it starts hiking again. Remember when the Fed said rates were at restrictive levels? Imagine them admitting they were wrong. Imagine a rate hike in the second half of 2025. The bond massacre of '94 would look mild by comparison. Long-term yields could spike above 6%. The housing market would collapse. Stock valuations would crater. We'd be looking at a genuine financial crisis, not just a correction. This is the scenario the vigilantes are hedging against. This is why they're demanding higher yields now, just in case. I'm not predicting any specific scenario. Markets are complex, adaptive systems that defy precise prediction. But I am saying that the range of outcomes has widened dramatically. The tail risks are fatter than they've been in decades, and the Fed's traditional toolkit is not working. So what should you watch? If you track only one thing over the next few months, track Treasury auction results. Specifically, watch the bid-to-cover ratio. Here's what that means. When the Treasury Department needs to borrow money, it holds an auction. It announces how much it wants to borrow, say $20 billion in 10-year notes. Investors submit bids indicating how much they want to buy and at what yield. The bid-to-cover ratio is the total amount bid divided by the amount offered. If the Treasury offers $20 billion and receives $40 billion in bids, the bid-to-cover ratio is 2. That's generally considered healthy. Strong demand. Historically, ratios above 2 indicate investors are eager to buy. Ratios below 2 suggest weak demand. And when demand is weak, yields rise because the Treasury has to offer higher rates to attract buyers. In May 2024, we had a weak Treasury auction that sent yields spiking in a single day. The bid-to-cover ratio came in well below expectations, and the market immediately repriced. If that pattern repeats, especially during the debt ceiling negotiations, especially if there's any perception that the Treasury might have trouble funding itself, it will be the clearest signal that the bond vigilantes have won, that the market, not the Fed, is now in control of interest rates. Watch the auctions. Watch the bid-to-cover ratios. That's where the truth lives. Before I close, let me bring this back to the three questions I posed at the beginning. Who benefits if this goes wrong? Counterintuitively, certain players do benefit from fiscal chaos. Short sellers who have positioned against long-term bonds. Foreign governments holding gold and other dollar alternatives who would benefit from dollar weakness. Domestic politicians who can use fiscal crisis as justification for their preferred policies. And paradoxically, the mega-cap tech companies whose cash hoards become even more valuable in a world of tight credit. Follow the incentives. They'll show you where the risks are. What's the real trigger? It's not inflation. It's not the Fed's policy. It's the debt trajectory. $2 trillion in annual borrowing with no plan to reduce it. $879 billion in annual interest payments and rising. The mathematical certainty that these numbers will keep compounding until something breaks. The vigilantes saw this coming. They positioned accordingly. And now they're demanding compensation for the risk everyone else is ignoring. What's the hidden metric? The term premium. The extra yield investors demand to lend long-term. When it rises, it means confidence is falling. And it's been rising steadily since the Fed started cutting rates. This is the metric the Fed won't talk about, because talking about it would mean admitting they don't control it. The term premium is set by the market, by millions of individual decisions made by pension funds, insurance companies, sovereign wealth funds, and yes, bond vigilantes. And right now, it's screaming that something is wrong. Here's what's true. The Fed is cutting rates, but long-term rates are rising. This divergence is unprecedented in modern rate-cutting cycles. The cause is not mysterious. It's fiscal policy, the debt, the trajectory, the market's rational response to unsustainable mathematics. Here's what's missing. Any serious plan from either political party to address the fiscal trajectory. Any acknowledgement from the Fed that its rate cuts aren't working as intended. Any mainstream media coverage connecting these dots in a way ordinary investors can understand. Here's what I'm watching. Treasury auctions for signs of weakening demand. The term premium for continued deterioration in confidence. The Russell 2000 versus NASDAQ spread as a real-time indicator of credit stress. And any hints from the Fed that it understands the game has changed. If this investigation helped you see the market differently, consider subscribing. Every week, I pull the filings, trace the flows, and connect the dots that mainstream financial media misses. This isn't about predictions. It's about understanding the mechanics, about seeing the patterns before they become obvious, about preparing for scenarios that most people aren't even considering. Drop a comment below. Do you think the bond vigilantes will win? Or will the Fed find a way to regain control? I want to hear your perspective. I want to know where you think my analysis breaks down, because the best ideas come from debate, from challenging assumptions, from pressure testing theories against opposing viewpoints. And one more thing, if you disagree with anything I've said today, tell me why. Tell me where the logic fails. Tell me what I'm missing. Because if I'm wrong about this, I want to know. And if I'm right, we all need to be prepared. This is not financial advice. I'm not telling you to buy or sell anything. I'm not predicting market direction. What I am doing is education and pattern recognition. Showing you the data, connecting the dots, helping you think through scenarios that could affect your financial future. What you do with that information is entirely up to you. Thank you for watching. I'll see you in the next investigation.